Can you all see my screen here? It's working, okay. So my name is Nick. I'm from the Master of Global Finance program at Fordham. So this idea of having this workshop actually came from this summer. I attended a workshop from School of Jobs. They were hosting a free financial modeling workshops, and I attended it, and it helped me kind of fill in a lot of the knowledge gap that I had in accounting and financial modeling. And I know that many of us are taking courses in financial modeling or even in accounting classes, but sometimes there's just that one item that we don't really understand on the financial statement. So I kind of put up this financial modeling workshop so that we can, using the School of Jobs, their material, so that we can, all of us can get a better understanding on how to conduct a 3-model workshop. All right, so we will be using Marriott's case for this workshop, but what happened is I think many of the students who are attending here today are from undergrads. So many of the students might not have that deep knowledge in the financial statement, especially in things like a cash flow statement. So what my plan is today is to basically touch on the surface of how things are connected to each other. I have very detailed schedules prepared for all of these connections. So if you have questions, we can definitely dive into specific ones, but I will probably stay on the surface for most of the time. So here's just a more of introduction that I used to work at PEVCC as an auditor, but I didn't really enjoy the backward-looking experience. I really enjoy more in forward-looking forecast and modeling. So that's why I decided to pursue a career in finance. And I interned at private equity companies, and now I'm interning at UniCredit in the corporate credit analysis department. So financial modeling is really a huge interest of mine, as I really love crunching numbers and putting my analysis into future forecasts. And outside of finance, I'm also a huge fan in photography. I like to sing and play guitar, and I also really like Japanese samurai, if that interests you as well. So here is what we'll be going through. So as I mentioned earlier, there's a slight change in the schedule, but I will focus more on the 3-statement model network, and how if you have, then I'll open up for discussions and questions, and we can dive into specific part of the parts that you think you might need a bit more of understanding or explanations. So we'll break down into these 3 sections. The first part is income statement. This is usually the first statement that we look at out of the 3 financial statements of a company. And this talks about the operations of what the company did in the past year. And then we'll be going to balance sheet. So balance sheet gives us an idea of what the company has on their book. For example, I have $100 in my pocket, and that is my asset, right? And I owe a bank $50. That's my liability, right? So this is the concept behind balance sheet. And we also have a statement of cash flow. So we might think that whatever comes in from our income, from our profit, is what the money we get, right? But that's not actually true, because many of the cash flows items that the cash we actually receive or spend are not listed in the income statement. And some of them are actually coming from the balance sheet. So we need to have a consolidated statement of cash flow to put those parts together as well. So first, I'll talk briefly on the structure of income statement. And the key of the workshop today is to make sure everyone have a good understanding of how each of the statement is connected to each other. And each items on the financial statement, they can be forecasted and they can be linked to another statement on the financial statement. And that's the magical part about financial modeling. And this is the part I love the most. So for income statement, we start from revenue, and then we will subtract cost of goods sold, or for service business, it might be cost of sales. And then we'll get a gross profit, and then we will subtract operating expenses, and these might be sales expense, marketing expenses, or a general and administrations. And we also have depreciations on the asset that we own. So for example, our new company, we purchased a manufacturing equipment, right, for a lifespan of 5 years. So most likely each year we will have 1/5 of that asset depreciating, and that depreciation is recorded into our income statement. And for amortization, it's kind of the similar concept, but this is for intangible assets. So for example, patent, for brand names, and even for goodwill, when you acquire a new business, you generate goodwills. So these are something that can be amortized, working in the same way as the depreciation. So we'll get operating income from this. And then we also have some of the other expenses, including interest expense and non-recurring other expenses and taxes. And then we'll get a net income. So all of these items, they can be found on other parts of our income statement, on other parts of our 3 financial statements, or it can be forecasted by us. So if you don't know later on, if you don't know which number, where I should find these numbers, we can definitely go into those. So the next part of the 3 statement is the balance sheet. So on the balance sheet, I think most of us might know that asset equals liability plus equity, right? And for the assets, we have current asset and long-term asset. Liabilities, we have current liabilities and long-term liabilities. So for the current liability parts are assets that are liquid on our book. So these start with cash, start with account receivables, inventories, prepaid expenses. These are assets that are identified as something that can be converted into cash within 1 year. And there are some assets that cannot be converted into cash in 1 year, such as the property, plant, and equipment. We call it PP&E, and also the intangible asset that we mentioned earlier, like patent, brand name, etc. And for liabilities, we have current liabilities. So these are some of the liabilities you need to meet within 1 year. So for example, if you owe, if you have balance on your credit card, you need to pay it off within 1 year, then this is your current liability. And if you have a mortgage, you need to pay it off in 30 years, then this is your long-term liabilities. Same sense for businesses. So for current liabilities, you have accounts like accounts payable. This is something that you owe to suppliers that most of the times are due within 90 days. And these are some obligations you need to meet with in short term of time. And for long-term liabilities, most of the times for companies, these are debts, these are loans that you owe to the bank, or these are bonds that you issued in the capital market to raise debt from the investors, from the public investors. So these added up to your total liability. And for the equity part, we have contribution from the shareholders. So here we can use the business example of a lemonade stand, right? So if you want to have create a lemonade stand to run your little business, you probably need to put in your own money, right? You need to put in your own money, and your own money is what you as a shareholder have contributed in terms of capital. And public companies, and this is actually the amount of money that they raised from the secondary market. For example, a company went IPO and they raised $20 million, and then this will be their contributed capitals from shareholders. And if the company issues any buyback, means they buy shares back from the secondary market, that will be reducing their contributed capitals from shareholders. And another part of the equity is the retained earning. So this is basically our little bank account accumulating our income, our net income every year, or it might be reduced because we have a loss. So so this also contributes to our total equity. So as we can see here, because it's based on our net income, so this item is really related back to our income statement's net income. So here we can attribute some connections between these two, right? By the way, if anyone has any questions, please always feel free to throw it at me. I want to make it more of a discussion and rather than a lecture style. Okay, let me take a look to see what, okay, anyways. So the third part of the three statement modeling is the cash flow statement. So in cash flow statement, we're basically kind of concluding all of the previous activities we did in our income statement and our balance sheet. So from the statement of operating activities, these are actually coming from our net income in the income statement, and also the difference between a current asset and current liabilities. That part might seem a little complicated at this stage, but that difference is called working capital. So those two parts made up to our cash flow from operating activities. And we also have cash flow from investment activities. And these are what the company has spent on PP&E, on their property, plant, and equipment, in their fixed asset. So whatever is spent there will be, cash flow deducted from the investment activities. The company might also sell a part of their assets, so that will be a cash inflow on that aspect. And the third part of the statement of cash flow is cash flow from financing activities. So earlier we mentioned that the company might be getting their money from either investors, stock investors, or from their retained earnings, or from raising debts, right? So these are the money that goes into the cash flow from financing activities. So, and what we do with the cash flow statement is because here, remember, we said current asset, we have a cash item, right? We have the first thing on the current asset portion of the balance sheet is cash and equivalents. And how we get that number, we cannot forecast how much the cash a company will have in the future, right? We will only be able to get it from our cash flow statement, using our previous year's year-end cash balance to add whatever inflows we have during the year and subtract whatever outflows we have in the year. And then this will give us the ending cash balance that we can put it onto our balance sheet under the current asset cash component here. So now that we got a better understanding of what the three statement looks like, and then we can go deeper into a three statement model network. I don't know whether there's actually a name like that, but when I created this this presentation, I just named it that way. So as we mentioned, we have these three main statements for any companies that we work with. Either you're working for a private equity, or with a VC fund, or with you're investing in a publicly traded companies. most of them will have all three of these statements. So in order to finish the three statement model, and we will also need a few schedules to help us to gather some of the input that we can put into each of our these statements. So the first schedule that most models will do is a depreciation and amortization schedule. So within here, we will record how much does a company spend on their capital expenditures, also called as property, plant, and equipment. How much new equipment have they purchased during the year? So in that term, we can be able to identify how much depreciation and amortizations the companies will incur during the year. So another schedule that is really important is the debt schedule. So because company really relies on debt to finance their operations or their growth. So we want to know how much debt are added onto their balance sheet and how much interest expense might be occurring because of that debt amount, because sometimes it's really, it can be really big, the interest expense. I remember when I was trying to looking into investing in airlines, I think airlines, American Airlines, their interest expense is actually more than their earnings. So that is something that we definitely want to look into. Oops, is there questions here?
No, it was me.
Okay.
Just
Okay.
if anyone feels shy but you want to ask a question, please feel free to send it over to me privately and I can ask it for you. You don't feel like raising your hand.
Sure. Thank you. Thank you. Yeah, that happens to me sometimes too in these conferences.
Yeah, no problem. Yeah, please feel free. Send over your questions to me and I'll ask Nick.
Yes, yes. We have a lot of time to discuss today. So that's about the debt schedule, right? As we said, debt is a huge part of balance sheet. You know, most of the company have debt. The more mature companies, they definitely do. So the third schedule that will help us to better create this three modeling network is a working capital schedule. So, oops. So working capital is the company's non-cash component of their current asset and their current liability. This is something that most companies, they will include in their annual report, and this is something that we can easily forecast in our model. If you have questions on this, please ask me later or now, and I can definitely dive into this. I have a special slide just for the working capital, or any of these schedule. If you have questions, I have a specific slide for this. So now let's connect the dots. This is the most exciting part. Okay, so how are informations fed into each other? So first, let's recall that in an income statement, right, we have these items, right? We have all these. Hope you still remember. And for cost of goods sold, for operating expenses, these are items that are generally can be forecasted based on, you know, what the company's forecasted revenue is. You know, most of the time we can forecast a company's revenue based on the industry trend or based on, for example, Amazon, they have a subscription, you know, they have a certain amount of user paying certain amount of money every year. So that is a good starting place for us to create those forecasts. And for cost of sales, because this is more related to companies, you know, raw materials, or for a service company, it might be the contractors that they hire to perform those services. So these can also be projected as a percentage of the revenue, because the more service you want to provide, the more human capital or the more raw material you also need to have in order to generate that revenue, right? And same for operating expenses. These are something that's, for example, travel expense for the corporate. and also selling expense that go to the salesperson of the company. So it's the same as cost of sales. The more revenue you want to generate, the more you probably want to spend on the salesperson's salary, right? So these two items, they usually grow in line as a percentage of revenue. And actually, most of the items on the three statement model network can be projected as a percentage of a revenue. Okay, 1 second, let's see. Oh, okay. What is the difference between cost of goods sold and OPEX? Great, great. So this is a accounting question. So let's take a company as example. Let's take a food company, Coca-Cola. How about that? Coca-Cola, everyone knows. So for cost of sales is what the company has to pay in order to create that product. For whatever they're selling, they are spending the money into the raw materials. For example, the bottle, the water, and the ingredient, the sugar. These are the cost that contributes to the cost of sales, and also called as cost of goods sold. And for operating expense, you can consider it more as a corporate level. So for example, the Coca-Cola, they need to promote their business, right? They need to put ads in the subway, they need to put ads on the street, and they need to find these advertisement agencies to do these works for them. So whatever they're spending on there is part of operating expense, because this is not directly related to their products that they sold. So whatever product cost that incurred in the production of the product is booked into cost of sales, and all of the other corporate related expenses are recorded here. So I hope that answers your question. Okay, okay. Marketing expenses are part of OPEX. Yes, marketing expenses are part of the operating expense. Most of the time we see OPEX having sales expense, general and administration, for the corporate salaries, things like that. Yes. Okay, so yeah, so now we were talking about these two, right? We got understanding of these two. And then we remember there's a depreciation and amortization expense. So this is really depends on the balance sheet. We have a D&A schedule that tells us how much we are spending on our fixed assets. And that fixed asset depreciate over time, as I was explaining earlier, and that depreciation is booked in here. So let's bring back the example again. If I buy this phone for corporate purposes, I probably need to replace it once every 5 years. So each year, the company will book 1/5 of that of that phone's value. So that 1/5 of the phone's value will be going into depreciation expenses. And same thing for amortization, which is for intangible assets, including goodwill. Okay, Nick, can you explore more on the debt schedule? Oh, okay, great, great. I think I'll go into the debt schedule once we hit the balance sheet, because I think the logic might be easier to follow when we go there. I hope that's okay. So after we have this expense, we can have our operating income. So this is whatever the company is making to their pocket from their operation. And all of the other expenses or incomes, these are not operation related. For example, interest expense. This is a part of their financing activity. And interest expense actually is coming from our debt schedule. How much debt do we have on our book? And what is the interest rate that the company is paying on its debt? So this is how we can forecast future interest expenses. And other expenses or other gains other losses, these are actually non-recurring expenses or non-operational expenses. For example, a company, they bought a building, a company that is not into real estate. They bought a building, and then 2 years later, they sold the building, but sold it at a loss. And that loss is recorded into other expenses. So this is not recurring expenses, and this is not, this is not a recurring expense. So after we subtract that, and we got an income after this line, and then we need to do what? We need to pay the government, right? We need to pay taxes. We need to pay for Uncle Sam, and the tax expense. These is depends on the tax rate, and we can. But for companies, they might have a lot of tax exemptions or tax benefits. But this is something that we can forecast based on the previous year's tax expenses. We can kind of calculate how much percent of a tax does a company pay in the previous years, and we can use that as a starting point to forecast how much tax a company to pay in the future, because that is also determined by a percentage, right? So, okay, good. So here, as we said earlier, interest expense is fed from the balance sheet where we have the debt amount, and depreciation expense, we will be getting it from our D&A schedule, depreciation and amortization schedule, where we calculate our CapEx. And whatever we got from here, the net income, remember, we are feeding that back into here, the retained earnings. So the net income eventually feeds into our balance sheet. Yes, let's see, we got another question. Why isn't special gain on this balance sheet? Okay, so special gains, usually we list it here. Here actually I think I'm missing it. So you can be other losses, other expenses, or other income, other gains. You can all categorize it here because these are not something that's recurring. So we put it below the operating income. Do not mess with the operating income. This is more important than this, because this is what the company is actually doing, and this is just sometimes accidents, right? Okay, and now we're at balance sheet. Let me get a sip of water. Oops. Okay, so let's recall. In the balance sheet, we have assets, liabilities, and equity, right? These two adds up to assets, right? So, so we have this working capital schedule to help us to forecast what the company's current asset is and what the company's current liability is. So if anyone wants to see this, I'll definitely go into this in a bit. But actually, let me just show you, because for me, it was the hardest part, understanding the financial statement. Let's see, where did I put that part? Oh, sorry, let's see. Oh, here we are. So in the working capital schedule, we usually have these current assets items and current liability items. So for example, accounts payable, this is a very important part, because most of the time when we sell our products, when we get our revenues, we do not really receive the money, right? Some companies may say, some of our clients may say, oh, let me pay you back within 90 days. So those amounts will be going onto your account receivable. And that is usually really stable as compared to revenues. And same for other current assets, for example, prepaid expense. Let's think about the case for Marriott, a hotel company, right? They, each hotel room, they have a phone line. So the company, they really need to have a telecommunication contract with, for example, AT&T or T-Mobile or other network company. So what they might do is they sign in a contract with one of the suppliers, and then they would book that expense separately year by year. So they might be going into a 5 years contract, and then they will record this expense once every year. As the hotel is getting larger, as the company is trying to expand, they will need to have more prepaid expense, right? Because the more customers means more rooms are needed, more phone lines are needed. So this also goes in line with the revenue growth. Let's see, there's a question here. Oops. Oops. Okay, or Verizon, yes, I'll just leave it here. Okay, and for current liability part of the working schedule, we have accounts payable. This is what we need to pay for our suppliers, but we might not pay it on the day when we buy. And also for accrued payrolls, for example, employees, we don't get paid for our work every day, right? We get paid once a month or twice a month. So the days that we already worked, but we haven't got paid, those actually for company, they will put into accrued payrolls and benefit. So because human capital is also growing as a part of the company's growth. So this is also reasonable to project based on the revenue growth. And when we make these projections, most of the times, we can look at the company's annual report to see whether they have a specific strategy of increasing their investment into human capital, or they want to cut costs from human capital. And then we can make some good intellectual projections about the future. If they plan on cutting staff by 10% in the next few years, then we will probably see this number to go down. But if the company plans to recruit more people, we'll probably will see this number to go up. Okay, so would we only expect proportional change between working capital and only for mature companies, also for early stage and growing companies too? I think this works better with more mature companies, because the strategies the company have to report it either in their audited financials or in their when they want to get investment, they need to tell the investors their strategies, right? So the more mature a company is, the more mature their strategy will be as well. So I think what you mentioned is right. I think proportional change might work better on mature companies. For early stage and growing companies, there's too many changes. We can only use our best judgments when we conduct the forecast. So if there is no other ways, no better ways for you to calculate the working capital, I would go ahead to use a proportion of revenue change. I hope that answers your question, Nathan. So for all these current liabilities, the working capital part, we can calculate based on percentage of revenue. So now let's go back to the balance sheet. So actually, I'll be ending on this page, because we don't have too much time to going into all of these fantastic pages. But we'll definitely look at them as needed. Okay, so now we know the working capital will help us to project the current asset and the current liabilities. Okay, and what's next is the long-term assets, right? Long-term assets, we're missing this part. So long-term assets is based on the D&A, depreciation and amortization schedule. So this part will tell us what the company is planning to spend in CapEx in the next year or the next few years. And the increase, whatever they will invest in, will increase onto their long-term asset. And if they have any depreciation, that will be subtracted from here, okay? So if anyone wants to see this, please send a note in the group and I can definitely jump into it. But once we get this, we can cross this part out. We have a way to forecast this. And then we have this one down as well. And we'll go into long-term liabilities. So long-term liabilities, as we mentioned earlier, they're mostly made up of debt. A company's debt, they get loans from the bank or they issue bond from the secondary market. So whatever we raised in that year, subtract whatever we repaid, is going to be the changes in debt that we have during that year. So if there's a positive change, we add it onto our balance sheet because we have more liabilities on our book now. So that is the way of us forecasting our long-term liabilities. Most of the time, a company will have plans on whether they want to increase their debt level because debt is a cheaper source of capital, or sometimes the company wants to reduce their debt level because higher debt means they need to pay higher interest, and that is really hurting their the income, the net income that they paid so much work into getting that net income. It's all getting destroyed by that interest expense. It's not gonna worth it, right? So let's see. There's a question here. Where do we usually find these schedules? Are they something that we would derive from comparing different statements from different years, or are they something else that's outlined somewhere else? Yeah, so these schedules usually we as analysts, we will create them based on the information that the company provide us. For example, the working capital schedule is made up of current assets and current liabilities, right? And the companies will provide us whatever they have on their balance sheet in the previous years, right? And we can make projections on the future years based on the revenue growth that we expect. So these are modules that we create by ourselves, and then the output of those modules will feed into our the outline of our three model statement network. I hope that answered your question. Okay, let's continue. So, okay, so now we have the change in debt, and then we cross this part as well. So remember here, we have contributed capital from the shareholders. So this is something that we will be able to find it from the cash flow statement, because the company sometimes they raise money from the secondary market, or for a private company they might raise that from institutional PE investors, and we usually see that inflow from the cash flow statement. And for retained earnings, earlier we mentioned that it's based on the previous year's retained earning plus any income, net income that we incurred during the year. So it's like our little pocket of money that's growing bigger and bigger, and then that becomes our equity. So now in the last, we have the cash flow statement. So recalling what we were discussing earlier, we have, so the ending cash depends on whatever we have in the beginning of the year, and add any cash flow from operating activities. So operating activities, earlier we said, earlier we said that is coming from working capital schedule, the net working capital. Oops, ignore this for now. Changes in net working capital, and we're also getting it from net income. So these two parts makes the majority of the cash flow from operating activities. And for cash flow from investment activities, we will be able to get it from whatever we spend on our capex, which we get from our depreciation and amortization schedule. So whatever is added onto the balance sheet in long-term asset part will be whatever we spend in investment activities. And then we have the cash flow from financing activities. So this is the amount of changes that we have in debt. So this is our debt financing, or anything we have in equity financing, we will list it by itself here. So once we get all of these input, we'll be able to calculate what is our ending cash balance. And that ending cash balance will go back to the balance sheet to complete our balance sheet on the current asset part. Because we mentioned earlier, current asset might have cash and other net working capital, including account receivables, inventories, prepaid expenses. So having this cash balance will help us to complete that part. And also, because we have cash, right? We have this ending cash balance and opening cash balance. We can generate interest income with that cash. It might be small, but it can offset a part of your interest expense. But for many companies, for large companies, they have a large amount of cash standing on their balance sheet, and most of them, they won't just let it spend in there. They might enter into any cash management programs that can provide them 1% or 2% of the interest income on their cash balance. So we will also get some interest income that will feed into the income statement to offset some part of our interest expense. So that kind of concludes how the three models work and how the supplementary schedules help us to feed information into this three statement and make everything flows within here. Whatever we see in the balance sheet or in the income statement or from the cash flow statement, we can find their source. It's all in here. Or there are something that we can easily forecast or require a special knowledge to forecast. So I think I will stop my presentation part there and open it for discussion.